Hello, Mr. and Mrs. Hess. How are you today? Good, good. How was your vacation? I hope that you had a really good time. I know that running away from the snowy weather and cold is so much fun. So I hope that you had fun in Florida. That's great. That's great. I'm glad to hear. Well, welcome back. And now to talk about the serious conversation. We'll try to make it easy for you. Before we start, did you receive the analysis that I sent you via email and mails also? Awesome. Oh, you have it. That's great. That's great. Because what we're going to do today is we're going to go over each one of those categories that I sent, and I know that it has a lot of information, so I would like to go over each one of them to make sure that we understand it, we are fully agree, and we can discuss the next step from there. How does that sound? Awesome. Awesome. Glad to hear. Okay. Now I have an agenda set. I will share it with you, and feel free to tell me if you would like to add anything to this agenda, both of you. Okay. Now I would like to go over the goals, what the goals that you want to get out of these meetings and out of our relationship. We're gonna put the risk and the assumptions, discuss them. Then we're going to get into your own situation, which is what's your financial situation at this time, what is the insurance and the risk management situation, investments, retirement, taxes, and estate. All of them, we're gonna hit them. Of course, we can have follow-up meetings to discuss something specific and or like a specific recommendation that we're gonna end it up with. How does that sound? Oh yeah, we can definitely discuss long-term care. It's already on my agenda actually, and we will discuss it too. What else? Do you want me to add anything? Awesome. Glad to hear. Let's get into it. Okay, so the first thing is that I know that we're meeting together to create a bigger look to your financial situation, to see where you are in the market right now in your retirement. Also, we have a specific goals, which is the estate plan, estate taxes and gift taxes, which we're going to discuss. Also, we are looking into your insurance, and one of them is the long-term insurance if it's possible to get. And also, we're going to work on reducing the income tax. And last not least is your risk tolerance, what type of recommendation we have for investments and for retirement to have a diversified portfolio. Does that cover all goals? All right, the 529. We will discuss that for sure too. Let me add that. It's in the thing, but in my analysis, but let me add that too. Great. Awesome to hear. Okay. Now, the market assumption or economy assumptions we have that both of you are now in a the highest federal tax bracket, which is the 37%. We have inflation at 2.25%, and we also have that you carry a little bit of a credit debt that you agreed to pay right away after your vacation, and also that you have a high net worth, which gives you flexibility to pay this credit and also to have other assets that we're going to look into, see how we can take advantage of that, and put it in your plan. Did I miss anything? Awesome. Great. Now, the first thing is the overall financial health. Before I start and get into it, I really want to congratulate both of you. You both did really, really a good job saving, investing. I mean, everything is showing from all the analysis and the worksheets that we work together, the balance sheet, the cash flow, all of them, they're really showing how much you worked And so congrats. That's for sure. Now, the first thing that I wanna talk about is that you don't have much of debt, which is a great thing that leads to have flexibility of what we can do and what we can't do. We have this small 10,000, which is in a credit card that you're going to pay, which is great. And we also have whatever left on the vacation mortgage to pay. Correct? That covers everything. Did I miss anything? Great. So, and I noticed also going over your assets that you have very big amount in CDs. And CDs usually is added to something called cash and cash equivalents. And when we take that and we take your debts, we will end it up with, and divide it with your debt, we will end up with something called current ratio. This current ratio will show us where are you in the market, comparing to liquid assets and to debt. Now, we usually want our clients to be at 1 to 2. Now, you are on the over 36. While that is great because that means you are comfortable, you have a lot of liquidity, you don't have to worry. But at the same time, it's telling us that you're missing out some opportunities in the market. Now, my job here is to make sure that you have that covered. Okay? How does that sound till now? Great. Now, this amount, I know that you mentioned that you have a 40,000 need of cash, right, to buy a car. Awesome. And also we want to make sure that you have the emergency funds that covers 3 to 6 months of payments, right? We discussed that before, and we're gonna want to keep it. I also would really recommend paying this vacation mortgage. Now, it depends on the numbers that I calculated. You have 54,900 left in that mortgage. Is that correct? It's very, very close. Yes. Now, you're paying a 5% interest on this mortgage. Now, I know sometimes that this is like a very big amount, 5%. Now, if we got rid of this mortgage, that means we're getting rid of this 5%. In return, we're taking out and investing the rest of the funds so we can balance this 5% that you got rid of. Make sense? Awesome. Awesome. Great. We will get back to it. We will discuss it in details, but this is one of the biggest recommendations that I can give you. Now, you can ask me, how would I pay this mortgage? I'm more than happy to share with you. Now, you have over 800,000 in a CD. This CD, when this CD matures, which I'm actually waiting for statements to see when it matures and all of that. So if you don't mind working on that, we will discuss that too later at the end of the meeting. But you have 800,000 in that CD. Now, when this CD mature, let's consider that we have between 55% to 65% invested in a balanced portfolio, tax efficient investments that can help you with getting growth. Then we will take 54,000 and throw it into the mortgage, pay the mortgage, forget the 5% that we're paying, not wasting it on anything else. That will leave you with what? With 40,000 that you can spend on the car that you would like to pay, to buy, sorry. And also will leave you with the 6-month emergency funds and with extra cash. What do you think of that? I know. It's great. I have all the numbers as you see. It's 54,000 going toward the house. 65% of this 800 is going to go into this investment strategy that we're going to discuss, of course. And the 40,000 will go into the car that you're going to buy. That will leave you with around 200. That will be between emergency fund, and also will be an extra cash that you have in case of any emergency or in case of anything. Now, I want to mention something. Now, you have all of your funds in one place. Now, the FDIC insurance covers only 250,000 for cash deposit and CDs that held at banks. Now, if you decided to go with my recommendation, that will covers everything, and you don't need to do anything. All of your funds will be insured. Now, if you decided to not to go with it, we would need to figure out how we can fix the 250 and leave 250 in two separate accounts so we can have them all covered. But it's something to think about. It's very, very important. Awesome. Let's jump right away into the risk management, which is your insurance. Now, the first thing, I looked up your home insurance for the residence home and for your vacation. Now, your vacation home is good. The coverage is good. The only thing that is missing is for flood. And I know that you mentioned that it's in Vermont, and we need to make sure to add that. So, because in case of any flood would happen, the HO3 insurance that you have won't cover it, so it's all will be out of pocket. So let's work on reaching out to your insurance agent so we can add that. Now, the resident part, the only thing that stood up to me is that it's only covers 65% from the total damage of the house, which is around like 400,000. Now, depends on our numbers. Your house assessment came back as 775,000. That means there's a big amount that is not covered. So we recommend at least raising this to 620,000 in order to be appropriately insured. So that's also a very big, very important thing that you need to discuss with your insurance company. Okay, awesome. Auto policies, they're all good. The only thing that is we would like to increase your car coverage because it's only covered for 15,000 for property damages, which is not that much. Okay, awesome. Now we have an insurance names, riders and endorsement. Have you heard of that before? Yep, I expect that. It's just because not a lot of clients, or not a lot of people that they're not in the business, they would know it. Now, riders insurance, they're specifically for cover the they cover something like your stamp. Okay, now your stamp is now only covered as something that you own inside of the house. So if someone would steal it, something would happen to the stamp, it will be covered under the 1,500 coverage that you have for personal properties, which is not good. We don't want that. So I really, really suggest and recommend having a rider insurance on it, and also it's on your boat. So it's two things that they're very important. Okay, make sense? I know it's very scary, and then the stuff is very expensive and it's very valuable. So we want to make sure that you have you covered and insured. Great. Now it's for your favorite part, the long-term insurance. So you are both, thankfully, in good health. Your kids are in good health. You are comfortable financially. You have the good amount of liquidity, and especially with this installment payments that you're going to receive for the next 8 years, you are comfortable with having assets and cash. Now, and also, so we don't really recommend having you pay for a future expenses. Sorry about that. At this time, you will be paying, anyone that is over 65 years old will be paying really a lot of money toward their long-term insurance, and because the long-term insurance knows that you're going to use them, so they want to make sure that they're getting all the amounts. So you will be paying really a lot of amounts towards something that might happen in the future. Now, if you're not comfortable and you don't have this liquidity, we would suggest it and recommend it. But in your situation, we just feel like if you have this amount invested and making money for you, that will help you in the future to pay those type of expenses that will be better in this situation. What do you think of that? Yeah. I mean, that does make sense, but just think about it at the bigger pictures. You will get some deductible from the premiums that you're going to pay, but the premiums are pretty big for both of you. But let me say something, that let's go over everything, and then we'll make sure to get into it in details, and maybe we can sit down with a representative that can provide this service, and we can discuss it more. How does that sound? Awesome. Glad to hear. Great. Let's jump right into the life insurance policies. Now, you have really good policies, life insurance, but usually when someone gets or when we recommend life insurance, it will be for a few reasons: income replacements, especially for retirement, debt payoff if you have a big debt, paying for specific type of educations or big payments. The last but not least is administrative or expenses for death. Now, in your situation, you're almost debt free. We don't have that, so we'll take it away. You're set for income for the rest of your life. You have the Social Security, you have a pension, and you have the annuity. And on the top of that, we have 8 years of installment payment. So we'll get that away. Paying for education, we don't have that because you both are retired, and even your kids are retired. Even your kids are done with the school, not retired yet. And then last, administrative expensive. You do have savings specifically set on the side, which can cover all of that. You don't need to have an extra. Now, you can tell me, but life insurance, they're very good and we have the cash benefits. Yes, you do, but you're paying $28,000. I mean, $28,000 for just one on annually basis for something that you're not sure that you really need. I mean, that's for John. It's a very big amount. If we can work on getting the cash balance, which is for John is $955,000, and invested in the market in some managed portfolio that can get you some money and get you some growth that will cover your future, that will give you more income in your future, and without paying this $28,000 that you might ended up just not using it really. That's our recommendation for it. At least one of your life insurance, if not both of them. But okay. Now let's go right into though this is before I jump in, this is everything for the insurance. Did I miss any coverage? Awesome. Great. Now let's go into the investments planning. Now, you both, again, it's chapeau bas. You did a really good job. You guys prepared yourself for your retirement really well. And because of that, you are able to take a little bit of extra risk, which we agree that you both are open to that which is great, because that makes the profit hopefully higher, because it all comes together. Now, even if you have a balanced portfolio of mutual funds or stocks and diversified, this needs to be rebalanced and reallocated all the time. This is why we are here. Okay? When was the last time that you went in and you rebalanced it? It's been a while. That's okay. That's okay. I mean, we have a lot of opportunity. You have a lot on your plate. You just sold your business. You had a very successful business. So this is why we are here, as I mentioned. So it's good that you're asking us for help. Now, because you have the installment payments that you're gonna get, as I mentioned, this will be your guaranteed income. So you're gonna have 8 years of guaranteed income, plus a social security benefit, and the pension and the annuity if you decided to annuitize it. Okay, now this is a really good amount to have, because what we look here, we want your essential expenses to be covered by guaranteed income. Only guaranteed income. Now you're super set for the next 8 years. Now after 8 years, you will be leaning more on your investments and what the income that you're getting out of your investments. Now, how we can balance that? We can 3 to 5 years before the settlement installment payments ends, we're going to start revisiting your account and start switching your investment strategy to have more income. So that will prepare you to keep the same lifestyle even when those 8 years are over and you don't have the installment payments. Now, you might tell me how we can do that. This is what we do here, and this is what we're going to go over in detail with you. But for now, because we have this flexibility, I would recommend to switch your investments and have, because you have this availability to have a little bit of extra risk, switch your investments and have it in a professionally managed account with 70% stocks and 30% bonds. Now, this is easily can be implemented in your retirement account. There's no harm with that. There's no retirement. There's no taxes reported to the IRS. Nothing can be harm. Nothing can harm you. Now, for the other account, which is non-retirement account, we have to do it on in a steps. So you don't get hit with a big tax bill. Now, I know that no one likes losing, but we have a big opportunity in your stock portfolio. And I know that this is like probably not the best thing that you hear, but we have the big loss on stock A. Yeah, I know it's really difficult when you see that, but we can take a big advantage from that. This will cover up selling some of the other gains that you have in the account, so you don't get hit with a big bill, tax bill. Make sense? So you sell some of the stock A, you have the losses, then you sell the rest of the gains from the rest of your account, so you will have it balanced. And that way will help us to move into the 70-30%. This strategy called loss harvesting. So what's called tax loss harvesting. Have you heard about it before? Oh, you did? Oh, tell me about your experience with it. Oh, okay. That's great. That's great. I'm glad. I'm always happy when I hear that clients knows what I'm talking about, because they can relate to. And I'm happy to answer your question too. But this is really big opportunity we can take advantage of. Awesome. I'm glad that you are on the same page. What about you, Mary? Okay, that's okay. I mean, that's okay. We're learning now. We are all learning. So that's awesome. That's great. Now, both of you mentioned also that you don't wanna be invested in anything with tobacco company, which is something that I respect a lot. Everyone should be like that, but we can't say it for everyone, I guess. I want to mention that in your 401k, John, you have the large cap blend. This probably has some tobacco companies. This has the largest stocks, and it's like a big chance that you have it in there. So to make sure that we can take it we can get rid of this is by having your account professionally managed and giving the orders that you don't want something like this to be in your portfolio. Now, of course, if you're looking to have your 401k managed, I'm not sure because it's inactive, you can do that. So we will discuss options of your rolling it over into a retail IRA account, which is something that we're gonna discuss in your retirement summary coming up in the next one. But having professionally managed account help with a lot of different ways. One of them is not having a tobacco companies invested or anything that related to that. Also, one of the keys to truly successful investments is discipline and constant strategy for maintaining the goals. Now, this will take a lot of effort. You would need to be rebalancing, reallocating your investments all the time, and that will be taken care of by our managed team and portfolio specialists that will go in and do all of that on your behalf when you have a portfolio. Professionally managed portfolio. Do you have any questions? Yes, so we will be discussing all costs or everything related on expenses in details once we go through with it. We have a few steps before we get to that point, but I want to mention and explain why it was mentioned in here and what it is professionally managed account. Great. Yeah. No, I'm always happy to answer questions. Please don't hesitate to ask me anything and stop me if I'm talking too quick or anything. I'm happy to explain. Awesome. Great. Now, if we want to go into the retirement, you both are in a very good place in retirement. You had a few questions that I'm happy to go over. Before I do that, I know that Mary, you have your pension, and I didn't receive any documentation that saying that this is the information, this is the company. So please, let's make sure to have them for next time because it's very important for us to see everything to make sure that we know we have the big picture. So our financial planning will be successful. Great, awesome. Thank you for that. Now, you asked a question about Roth IRA and the normal traditional IRA. Basically, Roth IRA, it's after tax money that's saved to your retirement. You will have those money. You will pay taxes now on them. You will contribute to your account, and then this account will grow tax deferred. And after 5 years, after you're above 59 and a half, which both of you are good with that, you would be able to start withdrawing without paying taxes or penalties. That's the short way of saying what is a Roth IRA. Now, traditional IRA is as you would deposit money into it, you will get this money will be tax deferred. That means it will be taken out of your annual income. You don't get taxed on it right now. You will have it invested. It will grow tax deferred once it's time to start withdrawing from this account after 59 and a half, because so we don't get any penalties. You will have you will pay it as an ordinary income. Now you can make a conversion from your traditional IRA to Roth, but that means every amount that you do conversion for, you will pay taxes in the same year. So I don't recommend that, because this year already you already have big payments coming up from the installment down payment and other the income that you're getting for this year. So it's something to think about, but maybe not this year, maybe in the future. Now you asked if you can contribute this year. So you have 11,000 of earned income. You might tell me, no, I have like the million, that's also considered ordinary income. So contribution to those retirement account, it needs to be earned income. That means you're working and earning this income from it. So you have 11,000. Mary, you don't have any income, is that right? Awesome. So you would be able to contribute 7,000 into a traditional IRA, okay, and and the rest is, which is 4,000, it will be contributed into Mary's IRA. Now you, because of your income that is over the limit for Roth, you won't be able to directly contribute into the Roth, but what we can do is opening both accounts, Roth and traditional, deposit 7,000 for John, 4,000 for Mary, and then switching or converting from the traditional into the Roth, and that's what we call it, backdoor Roth. That means you will take advantage of this benefit for this year. So this is awesome. This is a very, very interesting benefits that you would be able to take advantage of it. How does that sound? Awesome. Yes. And we will discuss the conversion for other amounts for later. Later, with years later, once we have a little bit less of an annual income. Awesome, great. Yeah, but overall, your retirement, you're in a good place. You're saved really well. You worked really hard. So feel good about yourself, because you're in a very good place. Great. Awesome. Okay, now the serious stuff, tax planning. We have a few things. I went over your income, and for deduction for this year, you will be able to do the joint deduction, and it's the standard annual deduction for this year that will fit your situation the best, which is 21,500. And that's you might tell me that you have a lot more deduction, but for the IRS puts a cap for 10,000 for real estate. So this is why you won't be able to deduct over that. The Jenny stamp. Now you asked if you sold this Jenny stamp, what would happen? Now there is, let's try to understand it. Jenny stamp has few different commissions, taxes that needs to be paid, and then you will end it up with the specific amounts. Now we have, the first thing is 15% commission. Now before we get into it, now you're expecting that it's going to be 1.5 million. You will pay the 15% as commission. Okay, that will bring it, I'm just looking so I can have the exact number, 1.3 million. Your capital gains would be 817,500, and that's after we took the 500,000, because you your mom inherited it from your father when it was 500,000, then she gifted to you, so you will get the 500. You won't get the step up, so your cost base is 500, so you will end up with capital gains of 817. This will be taxed at 31.8%, which contain 28% for capital gains and 3.8%. This called net interest income. This is for specific income. You will pay extra fee. That's what you have. So you would owe about 259,965, which is a very, very big amount. There's way more benefits if you just kept it not sell it and leave it to your kids, they will inherit it. And then once they inherit it, they will get the step up, and then they can sell it and pay only the 15% commission, not a huge tax bill. So my recommendation is to keep it. It's valuable. It's gonna cost you a lot. You're gonna lose a lot of its value if you sold it at this time. Awesome. I'm glad that you agree on that. Now, installment payments. Let's go over it very quickly. Installment payments, every payment you have, it's taxed under 3 different categories. The first one is the basis that you paid, which you're not gonna get taxed on, which is, we calculated to be 27% of every payment that you're not gonna pay taxes on. Then we have the ordinary income. And the third is the capital gain, which is taxed under the 20%, because you're in the highest bracket of capital gains. Those are the 3 different taxes that or categories that falls under every monthly payments you get. Now, the down payment, it's only taxed under 2, which is the return of basis and the capital gains. There's no ordinary income with the down payment. Awesome. Great. RMDs, big thing. You're 70, you still have a couple of years. Oh, you're 71, sorry. I forgot that your birthday. You're 71, so next year it will be your first year of RMDs. Mary, you still have some time. Now, for RMDs, I know you mentioned that you're looking to look into a qualified distribution for charity, which is great. So it's a huge tax. It's a big win for charity, and also taxes. It's a tax strategy. Now, those type of distribution are not available for a 401k. So what we could do is, as I mentioned before, we can roll over your IRA, your 401k, an active 401k, into an IRA, and with this account, you can have those type of distribution, and you can also have it professionally managed, like we discussed before. Make sense? Also, Mary, we can roll over your 403b to have it also under IRA, and also you can follow the same situation. So we will work on both of them this way. Awesome. Great. Okay. Last but not least, we have estate planning. Now, something big that is missing is that you have not prepared any trust, estate documents. I didn't see any proxy, any power of attorney. Those are very, very important. So my number 1 suggestion is reaching out to an estate planner and start working on it. Now, there is a big difference between your estate John and your estate Mary. What we need to work with our estate planner is to equalize those 2 estates to have them 50-50, so we don't have this big issue. Okay, this is my number 1 advice that that you both need to work on, is meeting with an estate planner and start getting documents done. Now, you're not quite in the state or federal limit for estate, which is 12.06 million currently at 2022. But you're very close, so we don't want that risk to happen. So let's make sure to equalize it. Now, the difference between having wills, which you both have, and having a trust is big. Wills, it's great, you have it, it's organized, everyone will get their funds, but everything that gets transferred under the will go into something called probate. I'm sure you heard of it. It's a lot of money, it's a lot of costs, it's a lot of time. It might go into years. It needs court orders. There's a lot of taxes, so the executor that is taking care of this, it's gonna be in a lot of they're gonna have to work a lot and do a lot of things. So that's the main thing under wills. Now, the trusts is a living trust or a revocable trust. It will be created to have beneficiaries. You can have your house the vacation house, the resident house, the boat, the journey stamp. You can have everything listed under a trust, and everything won't go under probate. It will skip the probate. It will have it protected. It will switch from, for example, John's name to Mary's name, and you can create one from Mary's to you, and then to your kids, and then from kids to, it can go really deep. So I will recommend having a trust to take advantage of not going into a probate. So this is also, so we have real estate. Sorry, we have estate planning, not real estate, estate planning. It's very big, it's very important. Work on proxy, work on power of attorney, work on estate planning, equalizing the estate, and second, creating trust under both of your names to have everything protected. Now, third thing, which is the 529, you will get to contribute 16,000 each one of you to each one of your grandkids 529. You can have it paid also on a 5 years basis. So yes, this year you can pay for 5 years, which will end it up around 450 for the three of them. That you can get it done this year, not pay any contribution for the next 5 years, but you can pay them from now, which is a great opportunity that you have for 529, and to give them and gift them the money to make sure that they're having the education that they need when they grow up and they need to go to colleges. Let's also something that's very important to know, that every check or payment that you can make to an education or to an education institution or medical institution, you don't have to report it as a gift. You don't have to report it as something that you're going to pay taxes on. It's open. You can take advantage of it in case the 529 weren't enough or this happens sometimes. Also, last but not least, let's make sure to have beneficiaries on your retirement account. You Mary having John having Mary, because the big benefits that you have when having a spouse as a beneficiary, it's that when you inherit, if let's say Mary inherited John retirement account, she can roll it over into her own retirement account, and she doesn't have to follow the 10 years rule, which if someone is not spouse will have to follow it. Make sense? I know it's a lot of information. We'll make sure to go back to it. I just want to summarize everything quickly. We have very important thing. First thing, estate planner. Create those documents. It will take almost 2-3 months to create them. It's very important. So let's get started with it. Create 2 trusts. Let's open them, have the funds, and add beneficiaries. 529 accounts with 450,000 to each one of them, which is great cover for the next 5 years. Insurance policy, let's meet with your insurance company and representative to discuss your auto insurance and your vacation and house insurance, also to add the rider insurance. The life insurance, let's liquidate for you, John, have the cash value and invest it in the market, get the benefit out of it. Let's open up professionally managed accounts, 70 to 30, well diversified. Let's have your retirement accounts rolled over into those IRAs that is professionally managed, very easy, no taxes. Once the CD is matured and it's 800, we will take 65%. We will invest it in a very tax sensitive account that can help you gain some funds, but also protected taxes, and also get the 40,000 to pay your car and to keep emergency fund. Last but not least, pay off your debt, pay off your mortgage, also from this 800,000. And and the 11,000 contribution, 7,000 under John, and 4,000 under Mary. Convert them into the Roth. Let's make sure that this happens before 2023, April 15, 2023, because this is the max that you can wait. And let's make sure that all the rollovers happens before the end of this year, so we can right in next year we can have your balance for your RMDs. Okay? I know this is a lot. We will go over it. We will definitely answer your questions and make sure that you are understanding every piece of it. A lot to think of. Take your time, and we will meet again next week. Right? We have already that set. Feel free to reach out. Feel free now to ask me any question. Thank you so much.